Hi, everyone. Welcome to the week ahead. I'm Tony Nash. Today, we're joined by Johnny Matthews. You know him on Twitter as Super Macro. Also, Albert Marco and Tracy Schuchart. Today, we're talking about bullish economic resilience. Johnny's got some great charts for us to talk through. We're also talking about the Fed and inflation targeting. There's kind of been a little bit happening over the past week on that, and Albert will go deep with us there. And then we just had an OPEC meeting, so we're going to cover OPEC in a little bit of detail, but we're also going to cover silver, both of those with Tracy, so we can understand what's happening in both of those markets. Hey, I'd like to make sure you know that you can access our AI-driven market forecasting tool called CI Markets for free. No strings attached, and it does not require any credit card information. Go to completeintel.com/markets to subscribe. CI Markets is the perfect addition to your analysis toolbox. This free account includes Nikkei stocks, major currency pairs, and global economics. Of course, we offer much more in our paid account, but this lets you experience CI Markets before making a financial commitment. CI Markets uses the power of AI to help you make better trading and investment decisions. It's absolutely free. Again, go to completeintel.com/markets to subscribe to CI Markets free. So guys, thanks so much for joining. I really appreciate the time you guys take and the thought and work you put into this. It means a lot to everyone watching the show. And Johnny, thanks for joining us for the first time.
Thank you for inviting me.
Yes, sir. You have sent across some great charts, and I'm looking forward to digging into them. The first is the 30-year fixed mortgage rate on current mortgage debt outstanding. I hear a lot of people talking about this, and the reasoning seems to be that the Fed rates don't really matter that much for existing homeowners. The difficulties arise when people buy a new home, whether they're kind of moving or buying a first home. So can you walk us through this chart and help us what it means, not just for mortgage holders, but the kind of health of the consumer in the US?
Yes, so the blue line is the current average rate on the outstanding stock of 30-year mortgages, and that is just 3.6%. So although the current mortgage rate for someone that wants to buy a house is something close to 7.5, it's come off its highs. People are just not paying that. You know, they're staying put, they're not moving house, and they're paying on average 3.6% rate. So they're kind of unaffected by these steep increases in interest rates that we've had. And in fact, I mean, I haven't got the chart in the pack, but if you look at actual debt servicing obligations of the household sector as a percentage of income, it's as low as it's been since the early 80s outside of the pandemic. I mean, households really not exposed to these higher interest rates. So as far as the consumer is concerned, the consumer is quite well immunized from what the Fed has done. And I'm hopeful that that will provide a great deal of resilience for the consumer going forward.
Okay, I mean, there seems to be a growing group of people who believe that. You know, we've had some guests on who started talking about this 9-10 months ago about kind of the bullish case that you're talking about, and I think, Albert, you're not quite so convinced. I don't want to put words in your mouth, but you're worried about it's kind of a second wave of inflation and additional tightening. Or do you still have worries there?
Yeah, I do. I mean, I absolutely do have a worry about the secondary wave of inflation coming, just because the Fed is notorious for making mistakes, and you know, I don't believe any of the CPI data that comes out, and you know, one wrong move, and you know, we're back into the 4, maybe even 5s in inflation target again. It's problematic.
Yeah.
So I mean, obviously, it's not. I don't. It might not happen. They might keep us in the 3s for however long in 2024, but you know, it certainly should be a worry.
Right. Yeah.
And well, go ahead.
Sorry,
I was going to say, I don't wholly disagree with Albert. You know, maybe it doesn't go that high, but I just don't think the Fed is going to get inflation down to the 2% target with what they've done so far, and with how well immunized the consumer is from these rate hikes. So, you know, we're still, if you look at total employment I mean, I know the unemployment rate has gone up, but that's because more people have entered the workforce. If anything, it's not like we're shedding jobs at the moment. So you've had this tremendous pace of income growth, certainly in the first half of the year, tremendous pace of job growth, and an enormous pile of wealth that the consumers are sitting on, and they are spending it. So we're seeing the Fed has conquered the easy part of inflation. Energy prices have been falling, used car prices, they've been in free fall for almost a year. So durable goods prices, inflation is down to virtually zero. So we're seeing big, steep declines in headline inflation. But if you look at core and you look at services inflation, I think that's where the Fed is going to have difficulty in getting it back down to 2%. And that's going to provide quite a solid base for inflation going forward. And my concern, along the lines of what Albert was saying, is that the Fed is going to think that they've scored a victory and start easing. Well, certainly that's what the market thinks at the moment. And if they do start easing too quickly, we'll get a second, inflation will get a second wind.
Yeah, imagine them cutting rates, early 2024, what the housing market would do. I mean, people that were sitting on the sidelines because, the rates are too high, or just start piling back into real estate.
Well, I think, we've seen mortgage rates. Sorry, Tony, I was going to say, we've seen the mortgage rate drop almost 50 basis points from its peak already. So, and it's probably going to come down even further with these declines in treasury yields.
I know some mortgage brokers who are really suffering, and we're in Texas, so the real estate market is relatively robust here still, as it is in Florida, of course.
I mean, and just in general, if you look at the recent housing listings, we literally hit the lowest amount of listings on the market in like 2 decades.
Right.
Even more so, than after the financial crisis, when everybody.
Yeah, but how much is that due to people just not wanting to leave their 2 or 3% mortgages for 7%? It's
and that's a supply issue,
Absolutely.
right? So that'll likely keep prices up because it's a supply issue.
Well, you have a supply issue, and then you also have a raising mortgage rate issue, in my opinion. Even though we came down 50 basis points, you're still looking at 7% compared to 3% or 2% whenever you locked your rate in, if you were lucky enough to.
Yeah, my first house in 2003, I think, or 2002 was 7%. So, and I felt like things were good. So I feel old telling those stories, but 7%, I think we could live with it if we had it for a little bit longer. Although or the magnitude feels dramatic, but I think it's doable. We've done it in the past. So let's move from consumer to corporate. Johnny, you sent this great chart. It looks like businesses are in good shape as they pay off debt. You're showing the blue line here is the net interest paid as a percentage of profits, and the red line is the Fed funds target rate. So with this, what's the average maturity of corporate debt, and how big of a risk is it to see debt roll over for companies to have to get higher risk? So is this generally long-term debt, or is this a combination of long and short-term debt?
Yeah, I think, first of all, let me just explain that this is from the NEPA accounts. So this is not just S&P companies. We're talking of the whole economy, basically, all corporates. And you can see in that period during the 70s and early 80s, when the Fed hiked rates, companies were paying a much higher percentage of interest as a percent of profits whenever the Fed pushed rates higher. But then once we had the financial crisis, I think what happened was, we had rates, the yield curve was flat as a pancake. Rates were on the floor, and companies termed out their debts. Now, we're not seeing the distribution here. Obviously, the biggest company with access to the capital markets are able to issue bonds and lock in really, really low rates for very long periods of time, like Apple did. They issued 40-year bonds. So for the larger companies, that have done that, they are in great shape, and they're the ones that generate most of the profit, which is why you're seeing this effect here, where you're seeing net interest as a percent of profits is the lowest it's been in decades. And so the impact of the Fed's rate hikes on the corporate sector are nowhere near as painful as they used to be. Now, I wasn't able to get the distribution of maturities, of debt. I mean, this data covers just all companies of all sizes, and so we don't have that data available. Some of the investment banks have done a reasonable job of estimating the debt distribution of the S&P companies, but for the most part, the larger companies, this is just not a problem. Obviously, for the smaller companies and in the high yield sector, they're really going to have a problem. But, we spent a decade listening to people moaning about zombie companies being kept alive by ultra low rates.
Yep.
Well, now's the time to clear them out.
Yep.
Let's have a bit of that creative destruction that everybody was missing over the previous decade.
But you're right. I mean, it's, interest rates cause this stuff. So, I think you're right also that I suspect all the large companies refinanced and issued new debt at zero or whatever for long periods of time. So anybody who didn't, the CFO should probably be gone. But it is the smaller companies that really don't have that term luxury who are probably suffering with this.
Yes, I would think so, which is perhaps a little unfair. It does give the biggest companies an advantage, and they're able to grab more market share. But that's just the way evolution goes in the corporate sector.
Yeah, the risk of being with a small company is coming back, and that's what interest rates. There really hasn't been a cost to risk for a long time because interest rates have been zero or negative, and we're seeing the cost of risk come back, pretty strong. So, let's take a look at rate expectations. So this will flow into Albert's section really well. So it seems like there's an expectation to see rate cuts in Q2 of 24. Of course, that'll be great for some people, but what brings that on? What do you think is in these rate assumptions to bring on these rate cuts?
Hope and dreams of getting their portfolios up. I mean, a lot of the people that are not demanding, but vocal about cuts are the guys heavy into the tech sector that love to see us go back to like 1%, you know what I mean, or even zero rates. I mean, ludicrous to talk about. So, I mean, I've actually heard some people say that 5% is going to be 1% within by September or whatnot. I think it's just crazy at this moment. It's just I can't see the Fed making such an obvious mistake when most of the Fed speakers come out and say we're not even talking about or even thinking about cuts. Why is the market talking about this right now? And the market's been wrong.
That's what Powell said today, Friday, right? He basically said that.
Yeah, even somebody else that came out there said the same thing. I don't understand why this pivot talk comes up every 2 months, or pivot and pause right now. Okay, we have a somewhat of a pause, but I still think that we're probably going to get another rate hike or two. Especially if core and super core inflation goes up, starts ticking up, they're going to have to do it.
Okay, Johnny.
Well, Yeah, I think at the moment these are market implied rates, and at the moment the market is just selectively latching onto every sign of weakness in all the data. Like, for example, the manufacturing PMI that we had today from ISM. The new orders was at the second highest level that it's been in over a year, and that's kind of a forward-looking indicator of where this ISM index is going. But the market just looked at the low level of the headline index and just pushed. I think the 2-year yields has made a new low for the week. So these are what the market. At the moment the market's got the bit between its teeth as far as rate cuts are concerned. And And so, just looking at this chart of rate cut probabilities, by May, the market is saying that there's only a 15% chance that rates will be unchanged.
Right.
And, the market is now pricing in over 100 basis points of rate cuts next year. Yeah, which I think is ambitious, hopeful. I just don't think it's going to happen. And like Albert says, my concern is that we've done the easy part of getting inflation down, and this hard part is going to be much more challenging. And we may well see a bounce in some of these factors that were heading south very, very fast. Base effects in energy. We're looking at a year-over-year price changes that's going to change direction soon. As we go into the early months of next year, we're going to find energy prices probably higher than they were a year previously. So, these kind of effects will start to have an upward impact on inflation, and you've still got that high base from services inflation, which hasn't, I think it was 4% at the last inflation print.
Mm-hmm.
So, hopes of over 100 basis points of rate cuts next year, I think it's the market's dreaming.
Yeah, I mean, with the charts you have, the consumer is strong, business is strong. I'm just not like Howard. I'm a little bit puzzled why we're seeing rates expected to be below 5 by June. With
That's
everything
impressive.
that's strong.
And the Fed hasn't changed their mantra. I mean, Powell has been very adamant, higher for longer, hasn't changed, but the market keeps trying to second guess him. And this is not the first time, right? I mean, we had rate cuts actually priced in earlier this year, which of course were priced out of the market. But, if you listen to the Fed, they're telling you higher for longer. And the markets are thinking, they get really excited over any kind of dip in economic data, so to speak.
But it's like a double-edged sword. I mean, dip in economic data lowers demand. Labor market is going to be affected going forward into an election year. The Fed has been mindful and very vocal about a soft landing. Well, maybe we already had a soft landing, and maybe we're in the second half of the game here going into 2024. It's like, do we have another soft landing, or do we have a little bit of a harder landing? It's a debate that, I'm starting to have with myself going forward 6 months down the line. I mean, the rate cut idea is just absolutely mind-boggling to me. I can't see it until super core starts going under 2% CPI prints. I don't want to even talk about cuts.
Well, I guess the thing that I have started to see over the past month is people saying, maybe this time is different. And when I start seeing that, that's when I start to worry. When people start saying maybe this time is different. So I don't know, maybe it is, but it hasn't been before. So,
Well, I think
normally
it is.
People... Go ahead, Johnny.
Yeah, I was going to say it is very different to what people have experienced. We had the financial crisis that, and at the time we all read this Reinhardt and Rogoff book, 8 Centuries of Financial Folly, and in the book they said, right, you're going to have a decade of sluggish growth and low rates. You're kind of doomed to that, and they were right, and that's what we had. And people's expectations now are that rates are going to go back to that super low level. Then we had a pandemic where we shed, 20 million workers in a space of a month, and then tried to hire them all back as quick as we could. And it just wasn't possible. So we had all these supply chain snarls and excess labor demand. And the interesting thing after the pandemic, from my perspective, is that in the same way as the US, there was a much greater demand for labor than the available supply. The vacancies were running at twice as many unemployed workers, a much higher ratio than you'd ever seen before. It was the same in something like 20 of the top OECD advanced economies. the same thing happened. I mean, we had it in the UK where vacancies as a ratio to unemployed people were higher than they'd ever been. And it was the same. So there was this global shortage of labor. So it is different in a sense that we had a decade of doom and gloom, just unable to really get the economy motoring. Then we had the pandemic, and then everything was shaken up. And people are still, people have these biases that are influenced by their experience over the prior sluggish decade, and think that rates are going back down there.
Yep.
But they're not. This is a whole new world we've entered.
Yeah.
Yeah.
I would recommend anybody. This was recommended to me by someone on Twitter. It's a book called The Price of Time by Chancellor. If you have not read it, it's an absolutely interesting read on interest rates. Every time we have a period of low interest rates, when interest rates rise again, there is this kind of period of delusion where people think, it's higher interest rates really is going to impact us like it did last time. And then something happens. And so is that something going to happen? I don't know, but it's kind of happened every other time. So I'm not a doomer. Like, I hope it doesn't happen, but I'm always a little bit wary of that. Albert, go ahead.
Yeah, I mean, if you go back throughout history, I mean, humans do the same thing over and over again, just repurpose and regurgitate policies and rhetoric from the previous, from the predecessors. And I fully expect the Fed to do the same thing that was done in the 60s and 70s in terms of errors. Just the way humans are. I mean, they're looking for some kind of rally, and I think that they'll probably make a mistake leading up to it. I mean, inflation is such a problem, Tony, that, Barkin and a few other people are starting to come out saying, well, maybe we should talk about, moving the inflation target up a couple notches or making it fluid.
Okay, let's hold off on that. Let's hold off on that for just a second, okay? So let's close out. Tracy, do you want to kind of, in terms of this time is different or something like that, like, what are your thoughts on that? Because we're seeing crude at, relatively, I would say, average to low prices, but, it's not what people would expect given the level of demand that we're seeing. So do you expect those prices to kick up? We'll talk about OPEC in a couple segments, but just generally, just where we are economically. What's your view on? Johnny mentioned oil prices may, kick up next year. Is that your general view?
Yeah, and I have to just push back on what you just said just a little bit, because I think,
great.
first of all, at $76, oil is still higher. Do you know what I'm saying? Than the historical norm. So what
I'm buying the narrative that we're at cheap oil.
So
sadly,
yes, we have seen oil prices come down, but oil prices literally above $100 are not really sustainable, right? You would bring down emerging markets. It's terrible for everybody. It's terrible, but still, sustained higher oil prices at $76. Everybody thinks this is, we saw 120 after the Ukraine invasion, and then we saw another kick up to 95 after the conflict in Israel. But literally, we're still, if you kind of back out of your 5-minute chart for a minute, we're kind of in this range where we're at a, 72 to, say, for WTI, say a 72 to $85 range, a bit higher for Brent. And that is still historically higher than you've seen. And yes, we aren't seeing that really hit us right now in the US, but we are definitely seeing that hit in Europe, particularly in Germany right now, when you have a lot of companies leaving because energy prices are just higher there. And yes, I understand that has to do with a lot of, the policies they have, but still, natural gas prices have come down, things of that nature. But energy prices in general are still rather elevated compared to what they have been in comparison to historical norms. So, I think that absolutely the risk is higher energy prices next year. I think that's complete possibility. I think all eyes are kind of on the US right now for a multitude of reasons.
Great. Okay. Let's wrap that up and let's move on to Fed speak. Hey, I'd like to make sure you know that you can access our AI-driven market forecasting tool called CI Markets for free. No strings attached, and it does not require any credit card information. Go to completeintel.com/markets to subscribe. CI Markets is the perfect addition to your analysis toolbox. This free account includes Nikkei stocks, major currency pairs, and global economics. Of course, we offer much more in our paid account, but this lets you experience CI Markets before making a financial commitment. CI Markets uses the power of AI to help you make better trading and investment decisions. It's absolutely free. Again, go to completeintel.com/markets to subscribe to CI Markets free. Albert, there were a number of Fed speakers, and the Beige book was released this week. I think it's kind of easy to dismiss the Beige book, but there are some pretty clear statements in it regarding, slowdown in inflation and easing of job markets. So I've got on the screen a screenshot of the kind of the takeaways from the Beige book. It has phrases like demand for labor continued to ease, phrases like reduction in headcount through layoffs or attrition were reported, things like price increases largely moderated. So those are the things kind of at the top of the kind of takeaway sections, but lower in the takeaway sections, there are things like cost of various food products increased. Anybody who goes to the market understands that. Increased cost of debt as an impediment to business growth, which we mentioned with Johnny earlier on small companies. So that seems to show some continued headwinds. So what are your thoughts on that? I mean, it's kind of a mixed message.
Well, yeah, depending on which Fed speaker is talking and which way they lean politically. I mean, some of them want to, show that the market's resilient and the economy is resilient for political purposes. Others have better intentions of actually trying to get the economy on a stable footing at the moment. Labor layoffs are not coming fast enough for the Fed. I mean, I hate to be the guy saying such a thing because of the personal aspect of people losing their jobs and whatnot. But in terms of how the Fed's policies working, the layoffs are just not coming fast enough. And honestly, it's because no company wants to be that first one that lays off a significant number of employees because the political ramifications that comes with it in this atmosphere.
Well, and
right?
small
And we've talked
companies
about
employ more people, so having higher interest rates makes it harder for those small companies. So you'll see more small companies and mid-sized companies close, and I think that's where a lot of your layoffs will be found.
Yeah, but they can do a lot of stuff to help that, to alleviate that. I mean, the SBA loans that a lot of these small companies took up to $2 to $5 million can easily be forgiven. If they really wanted to sit there and help small and medium-sized companies, they can do stuff like that instead of letting layoffs gain steam or closures and whatnot. I mean, like I was saying previously, food prices, still on the verge of going higher. A lot of it's due to the energy issues of nat gas and oil going forward. I mean, there's a lot of derivatives in that, specifically fertilizers and stuff like that. Those become problematic. And, again, we like to harp on inflation in this channel, but it's sticky. Super core is sticky. It's problematic. Barkin is out there now saying, CPI targets should be, or inflation targets should be fluid or a little bit above 2%, which was absolutely dismissed. And I was laughed at when I said that this is probably going to end up happening about a year ago.
Let's go to that. Okay. So Barkin was out this week saying, and I've got this on the screen, I am open to an inflation target range after we hit the 2% goal. So he's saying that. Now in August, just a few months ago, he said a new inflation target would risk Fed credibility. So what's happening and what's changed since August for him to change his view?
It's sticky. It's hard. Like Johnny was saying earlier, they did the easy work. They got it down to 3 point whatever fake number they want to throw out there, right? But now to get this to an actual 2% target, they're going to have to do a lot of hard things, and I don't think they can actually do it. I mean, you know what? They could probably say, oh, look at this healthcare data is minus 68%, and shelter is minus 14. Oh, we hit 2%. Now let's change it. They could do something silly like that, but I don't think. I mean, the market and everybody else is just going to laugh at them. It's just they're going to lose credibility, like Barkin was saying a year ago.
Johnny, what's your thought on that?
Yeah, I really don't think they would dare change the target. But by the same token, I don't think they're going to hit it. I mean, if they do continue tightening or they hold rates, at the current level for long enough, and they start to see some further deterioration in the labor market, and unemployment continues to creep higher and higher and higher, with inflation at 3 or slightly lower, that will be good enough for them to cut rates. They're just not going to get it down to the 2%.
They'll talk about
target.
lags or something and say,
yeah, exactly. They put it in their forecast that with in the Phillips curve framework, with unemployment going higher, wage growth will continue to slow down, and that means services inflation will continue to decline. They can do pretty much whatever they like to come up with reasons for cutting rates, and that's what they'll do. If it means if getting down to the 2% target means sacrificing the economy and sacrificing a whole load of jobs and pushing unemployment up to 6%, they're just not going to do it. They're going to stop. At a little bit below 3%. That'll be good enough for them. And I think actually, for most people, they would think, okay, well, it's not so bad, if inflation was 3%, So
God help us if someone like Austin Goolsbee ever becomes Fed chair, because we'll have inflation targeting at like 6% or something. I mean, it's, people love to, be critical of Powell, but the guy is being, I would say, relatively disciplined in keeping prices at a reasonable rate. I mean, he can't help supply chain issues, right? But he's really staying very focused on this 2% target. And I think he should get some credit for that.
Oh, absolutely. I think he's, for the past few decades, I've had to listen to speeches from the likes of Janet Yellen and Ben Bernanke, which was so boring, my ears were bleeding, honestly. It was just unbearable. At least Powell, when you ask him a question, he answers the question. He doesn't just waffle on and try to skirt around it. He answers the question. He was asked recently, where do you think the neutral rate is? And he basically said, I don't know. I just don't know. Who the hell does know?
Anyway, right? So
yeah, who the hell does know? So, I really welcome that in the Fed chairman. He's very clear and down to earth. I really do like that. But just getting back to the labor market and what the Fed will do. One thing that we haven't discussed that is a bit of a concern to me is that when I look at the cyclical and non-cyclical components of job growth, what I call the non-cyclical government, education, and healthcare, that's showing now reasonably strong growth, stronger growth than the cyclical components, which surged after the pandemic. Point. And, now they're coming down and down and down. And so, in the last payroll print, it was something like 150,000 payrolls, 50,000 were with government. I don't know what the breakdown was between education and healthcare, but you can see what I mean. More of the jobs were in non-cyclical sectors. And that is really quite a concern to me. And I think the Fed will start to focus more on the labor market if this trend continues. So, getting back to your earlier point, Albert, and what we were discussing earlier, with inflation down where it is currently, if the labor market really does begin to crack, the Fed, they will start cutting.
Yeah, they'll say dual mandate, right? And they'll start cutting and say, I don't care where the inflation rate is, we need to start cutting for jobs.
Yeah, which will be a mistake, like usual. It'll be a mistake. Yeah.
True. Can we just have a moratorium on government jobs for a while in the U.S.?
Yeah, they should do a skeleton crew of just basic, 1/10 of what they have out there, and cut their salaries too until they get things right.
I love it. I mean, where do I vote on that?
Just in terms of,
can we put that on the ballot next election?
Right. Just in terms of inflation target, are there other central banks, say in Europe or England or whatever, who are doing inflation targeting right now?
Oh yeah, all of them. I mean, this whole inflation targeting thing, this 2% target, was just plucked out of the air by some. I think it was a treasurer of the New Zealand central bank. Just came up with 2%. Yeah, that sounds like a good number.
Sort of like COVID social distancing, you know.
And it stuck. It stuck. What one central bank after another adopted a 2% inflation target. So we have it in the UK. They have it in Europe. They have it in Australia, New Zealand. It's become a kind of universal thing. But it was just it's just a spurious number that they picked, and there's no real science behind it.
It's like I'm old enough to remember when 6% was the assumed natural rate of unemployment.
If they
remember
wanted
that,
to have,
like, this was in the 90s. 6% unemployment was normal.
Yeah, I mean, if they want to have an actual discussion on what an inflation target should be, I welcome that, right? But the fact of the matter is they've stuck to this 2% threshold, and if they deviate from it, it'll have repercussions.
Huge repercussions. Yeah.
Absolutely. I mean, we've already seen inflation expectations in the Michigan survey creeping higher. The longer term inflation expectations are the highest they've been in I don't know how long. And it's kind of strange to have 1 year inflation expectations going higher when gas prices are heading south. So, that is the big danger, isn't it?
How much is it? How much of it, though? Sorry to interrupt you, but how much of that is due to wage growth that just keeps on creeping up? Doesn't stop, really.
I think the two things feed each other, don't they? High inflation feeds higher wage demands, and then wage growth feeds into services inflation. It becomes that has always been the big fear of central banks, that you have this wage price spiral, and that's how it rolls along.
Yeah, but that doesn't exist, Johnny. We've been told for the last 3 years that the wage price.
Yeah, true.
We talked about that, Tony, I think even like a year ago, in the doom loop of wage inflation, energy inflation, and interest rates and so on and so forth. And here we are. Here we are experiencing it.
Same discussions, not a lot's changing aside from the interest rates. So I think I like your rosy your rosy charts, Johnny. I'm not quite sure. From that first segment, I'm just not quite sure how it all sticks in, say, the 3 to 6 month time frame. I don't want to be a downer. I'm just seeing some of those correlations, especially on that business chart, really break down over the last 12 months, right? And so, there are a lot of things around unconventional Fed policy, discussions about new inflation targets, other things where expectations in the marketplace, people don't know what to expect. They don't know if, their food is going to rise another 15% next year. They don't know if cars are going to be cheap or expensive, So, I think we do have a lot of this kind of slack in terms of what consumers have on the sidelines. But I think on some level, they're keeping dry powder because they have no idea what's going to happen. We're hearing about this new virus in China that's supposed to nobody knows what's going to happen. And they don't know the unpredictable factor. And going back to the government employment that you talked about, nobody knows what governments are going to impose on people if this thing really is a new thing, right? And so I think that uncertainty is probably hurting some government spending, some company spending, some personal spending, and other things. I could be very wrong here, but I think a lot of those expectations have kind of broken down because there's a lot of uncertainty around prices, especially at the household level.
Yeah, but Tony, the thing is like looking at Johnny's rosy charts. Well, he's probably going to be 90% right.
Of course, I think so too.
Over the next 6 months, 5 months of it is going to be absolutely what Johnny's talking about.
I think you're right. The part that worries me is the question mark.
Well, I put those charts together. I did another talk recently. I said that I've been a recession denier for almost 2 years now. When the yield curve first inverted and people were screaming about an oncoming recession, I just couldn't see it with what was going on. But I've got to be honest. some of the data more recently do suggest that, well, clearly the economy's lost momentum. I mean, it was never going to carry on growing at north of 5% like it did in Q3, but consumption growth that we saw in October wasn't bad. That was okay. And Q4 consumption growth could still be on track for 2%. So, the wheels haven't fallen off.
Right.
And I'm kind of hopeful that now that headline inflation has come down a long way, primarily driven by lower energy prices and cheaper gas, people have more discretionary income, and they're going to spend it. They're going to carry on. They're going to carry on spending it, and it's these services that are really benefiting. Sporting events, concerts.
Yep.
Whether it's Beyonce, Taylor Swift, people pay top dollar to get a ticket, and they're lucky if they can.
That's right.
$1,300 a ticket for the Michigan-Ohio State game. $1,300. Those were Super Bowl.
What sport was that, Howard? Is that wrestling or something?
Well, the real football. Listen, I'm a huge soccer fan, so I got to throw that dig into the British guys,
That's all right. We're used to it.
Tracy, you were raising your hand about services. Was there something you wanted to add there?
No, I wasn't. I'm sorry.
Okay.
That was an accident.
Okay.
That was
That's
a total accident.
Okay, great. So let's just keep talking though, since we're talking about things coming back next year and a little bit of uncertainty. There was an OPEC meeting this week. Can you talk us through what happened? Why is it important? And what are the expectations for next year?
Yeah, so absolutely. I think the major problem is we saw that big drop after the OPEC meeting, even though we had additional cuts. I think the market was expecting OPEC to have a solid plan and not to announce that additional voluntary cuts would be announced by each producer individually. But how it all shuffled out at the end of the day, and we saw the market kick up a little bit afterwards, and again today. But the long and short of that, the whole situation was what we have is we have 1.5 million barrels in voluntary cuts carried over from this year between Saudi Arabia and Russia, and then we have an additional 684,000 barrels per day cuts between several nations.
Okay. How long, if they agreed that today, how long before that's implemented?
So that's implemented starting Q1. So it'll start January 1st, because the current, there's two parts of this. The current agreement that was supposed to end December 31st, 2023. On the quotas, the depressed quotas that they came up with last summer are going to carry over again for another quarter. And then on top of that, we had additional voluntary quotes. So again, it's the same numbers, except for heading into Q1 for the group as a total. We'll have, the long and short of it is, we'll have an extra 684,000 barrel per day cuts from today's levels. From Q4 levels.
Okay, so you said something interesting. You said voluntary. So the 684,000, are these all voluntary cuts?
These are all voluntary cuts. You have the nations that were voluntary were Algeria, UAE, Oman, Kuwait, Kazakhstan, and Iraq.
Okay, so how voluntary is voluntary? I mean,
voluntary.
And how much of it is maintenance baked into the voluntary cuts?
Well, this is where you get, this is where it gets sketchy, but these are, voluntary cuts. I do expect, I think Iraq sounds like to me, they're counting on Kurdish oil not coming back soon. So that sounds like their voluntary cut to me, to be honest with you. And I think the rest, honestly would make those, I was not surprised UAE or Kuwait or Oman, would curb, less, I mean, I think who was the largest, UAE at 163K BPD, it's nothing for them. So the rest didn't really surprise me. They're very small cuts. And obviously you come into springtime and there's maintenance season for all these players. And so partially that factors in, but generally not for January or February. But, in those cases too, those, part of that also could be, they don't have to produce as much because they don't have summer demand anymore, domestically speaking. So there's a lot of ways you can look at this situation, but the market was really expecting a broader base cut between the group and it to be on the the final communique, and to say, we're going to do this plus another 1 million barrels per day. That's what the market was expecting because of all the nonsense headlines that were leading up to this.
Okay, so the market took it pretty much in stride, didn't see it as a big deal. Yes, it's more supply offline, but
yeah, I mean, we saw a significant drop. We saw a volatile drop from $80 to $76 in WTI. We're bouncing a little bit back after that. After the market's been seems okay with the fact that there still will be additional cuts.
Okay, great. Albert, what do you think on that?
I mean, it's just the OPEC game of,
right.
We're going to do cuts, and then all of a sudden, ship-to-ship transfers without transponders are moving everywhere in the Persian Gulf. It's like,
right.
Yeah, whatever.
Johnny, we're skeptics here on the week ahead, just so you know.
Oh, well, yeah. I mean, it sounds nuts to me. A bunch of these guys get together and agree, well, we've got to cut, 2 and a bit million barrels a day of oil production. I volunteered to do a couple of 100,000 a day, and they all share it out, but it's voluntary. Well, none of them are going to do it, are they? They're going to say, well, okay, they're doing it. I'm not going to bother. I'll just pump it out while the price is still where it is.
Right.
I mean,
they said it was voluntary, right? So
yeah, exactly. It was voluntary. It's voluntary. It's like anything else. Voluntary. You don't have to do it.
Yeah. And that data doesn't until the end of 2024 again. So whatever.
I will say in OPEC's defense, after the 2020 April debacle when oil prices went negative, and in March when they had the blowout and everything crumbled between Saudi Arabia and Russia, we have seen a little bit more cohesive of a group, and that has helped keep oil prices elevated. And, I think it's also interesting to note that Brazil has just joined the plus part of OPEC. I think that's generally politically motivated, but that'll start in January 1st, 2024.
Interesting. Okay. So maybe we'll see some Middle Eastern sovereign wealth investments in Brazil as a part of that or something.
I would not be surprised.
Interesting. Okay. All right. Let's move on to silver. I think, Tracy, there's some really interesting things happening in the silver market. Silver has been pretty strong lately. Now, we saw a huge run up in silver in 2011. And part of my reason for wanting to cover this is I'm wondering if we're going to head there again soon. So I guess the most fundamental question in a precious metal market like silver is supply demand. So silver production has been expected to fall about 18 million, and you sent me these charts, 18 million ounces in 2022, with the largest cuts in places like Mexico, Peru, and Argentina. So at the same time, we're seeing a huge upswing in demand over the last 2 years. So this is the second chart where the white line is total demand and the blue line is total supply. So we've seen silver supply fall, but we've also seen the price not necessarily keep up with that. So can you help us understand what's happening in silver markets? This third chart is showing decline in silver prices as the balance is in deficit. So what industries do you see driving demand, and what would bring supply back online?
Yeah, I mean, I think when you're talking about silver, most people think of it as in jewelry, and or physical investment such as gold, right? But you have to think about the industrial properties on the industrial uses for silver, and that's really 45% of the market, right? Really 27% is investment, and you're talking even lower percentages when you're talking jewelry or anything like that. And so when we're talking about industrial properties, especially with transition, green energy, this big push that we're having, we're talking, solar panels and EVs in particular. But you also have healthcare demand too, that is also growing. And that kind of demand's been there for a while. But if you want to look at where the demand is exponentially growing right now, we have to say, we have to look at, say, things like, solar panels, which have found that silver is much better for use in solar panels than anything else right now. That's long and short without getting too technical about it. And then when you look at, if you look at vehicles, for example, all the soldering and everything, it all uses silver, right? And then when you start talking about EVs and, hybrids and EVs, you're talking about more electric components than ICE vehicles already currently have. And so there's a lot of demand coming particularly from that industry.
Okay, so do you expect strength, like real strength, $30-$40 an ounce strength, to return to silver markets as a result of this demand at some point?
At some point, I won't say tomorrow. The silver market's very finicky. Most people, it's very volatile. You had the Hunt brothers, right?
Yep.
The silver market, and so and a lot of it's paper too. You have to understand, a lot of these things are paper, and so if I were looking to invest in kind of the silver markets, I would look for something that was backed by actual silver, just saying, rather than paper markets. But that's just a side note. This is not investment advice.
Right.
But I think that possibly we could return to those levels as soon as kind of people realize what the deficit is really going to look like. And, it's particularly, we're not in a nerfed world anymore, right? And if you have all these mining projects, they take a lot of money to finance, right? And so with rising interest rates, these make a lot of these projects unaffordable or harder to get off the ground because they cost so much more money. And I actually posted a chart today, which basically says that mine production is not expected to get to the highs that we were like anytime soon again in this current rate environment. And so that's also something to factor in. And I keep trying to stress that, these projects take a lot of money and a lot of money to borrow from the banks. And it's just not that affordable. It's just not as affordable anymore. And plus, you have got permitting issues. You've got all sorts of problems with them that are already conducive to the mining industry, trying to get a project off the ground, and interest rates certainly are not helping that.
But Tracy, if we couldn't get people to invest in things like silver mines and upstream oil and gas and all these things at zero interest rates, what's going to be the thing to drive them to invest with higher interest rates?
Well, if you were to invest in the market, you would be investing on the supply demand imbalance, not necessarily, or you would be looking at either current mining companies that are already producing and or mining companies that have already borrowed, already permitted, and maybe haven't started yet. You want companies that are halfway there, so to speak.
Yeah, no, that's really interesting. So the miners.
I've got a question.
Sorry,
Tracy.
go ahead, Johnny.
Yeah. Because this third chart of yours that shows quite a deep deficit of production compared to demand, and yet the price hasn't really responded up to now. The price is going higher has gone higher in the last few weeks alongside gold because the dollar has been sinking. So question one is how do you explain the fact that it doesn't seem to respond to demand or the supply deficit? And the question two is just a general question, because I was quite bullish of silver a few years ago when inflation just started to pick up. And I bought a silver miner on the expectation that, some of the factors that you were talking about before, where there are very high costs to running a silver mine. So when the price goes up, the profit in the mines, goes up a long way. It's a bit like owning almost like a call option on silver. In theory, if you own the mines, you should get that kind of payoff, except that maybe it was just the mine that I owned, but it seems to me like these silver mines underperform what you'd expect when the silver price goes up. So my second question really is, are you not just better off to buy an ETF or something?
Yeah, I mean, I would suggest that unless you really know your stuff on silver miners, they're a very difficult trade. And you also have to think, for the last 11 years, we've almost had, not a lot of supply, but supply on the market. So, we've had the last 11 years, it's been a terrible market to invest in. We've had more supply than demand. It hasn't, really gone anywhere. You've had no reason to really, if you're you're an investor and you want to invest in precious metals, so to speak, that hasn't been really the big trade either. I mean, gold's kind of gone sideways. Silver's kind of gone sideways. So it really hasn't been a really attractive market, so to speak, for investors, unless you're a very, very long-term investor. But I think that's changing, because if you look at that chart and you look at the last 3 years of deficits, that's more than the last 11 years of supply upside at all. And we're only talking, nobody's getting rid of this green push. Like, everybody's still gung-ho for this, right? And the EV push is still there. And so, in my opinion, I just don't see, I just don't see supply catching up with demand anytime soon. And I don't see any real new greenfield projects coming online right now.
I hate silver.
Everybody hates silver. It's been a terrible trade. I mean, it's been a terrible trade. I think for the first time we're seeing opportunity, particularly because we're seeing this demand in transition materials. We're also seeing higher demand in the healthcare industry, right?
Yep.
So which that demand is always already has been there, but again, it's not a market for everybody. I mean, it's not an easy market to stomach at all.
Yeah,
that and nat gas are widowmakers for me.
Yeah,
they're notorious.
This is fantastic. Thank you, guys. Thank you so much for all the thought you put into this. Thanks so much for sharing your insight. Really appreciate it. Have a great weekend and have a great week ahead. Thank you.
Thank you.
So much. Thank you.
That's it for this week's episode of The Week Ahead. Please don't forget to rate us and review on whatever platform you are watching or listening to this. Thank you.